Good morning, and welcome to our release of first quarter 2024 performance results for FDIC insured institutions. The banking industry continued to show resilience in the first quarter. Net income rebounded from the non-recurring expenses that affected earnings last quarter. Asset quality metrics remained generally favorable, and the industry's liquidity was stable. However, the industry's net interest margin declined as competition continued to pressure rates paid on deposits and asset yields declined. The banking industry's net income of $64.2 billion in the first quarter was an increase of 79.5% from the prior quarter, and that's mainly due to lower expense related to the FDIC special assessment and lower goodwill write-downs. Otherwise, net income, factoring those matters out, net income in the first quarter would have increased 14.3% from the prior quarter as higher non-interest income and lower provision expenses more than offset a decline in net interest income. Community banks reported net income of $6.3 billion. That's a quarterly increase of 6.1%, driven by better results on the sale of securities and lower non-interest and provision expenses. The industry's net interest margin declined by 10 basis points in the quarter to 3.17%. That is below the pre-pandemic average of 3.25%. Continued deposit competition caused funding costs to increase during the quarter, while the yield on earning assets, such as loans, declined. The net interest margin for community banks also declined in the first quarter, and it remains below its pre-pandemic average. Unrealized losses on available for sale and held-to-maturity securities increased by $39 billion to $517 billion in the first quarter. Higher unrealized losses on residential mortgage-backed securities resulting from higher mortgage rates in the first quarter drove the overall increase in unrealized losses. And this is the 9th straight quarter of unusually high unrealized losses since the Federal Reserve began to raise interest rates in the first quarter of 2022. The industry's total loans declined by $35 billion, or 0.3% in the first quarter. Most of the decline was reported by the largest banks, in line with a seasonal decline in credit card loans and lower auto loan balances. The industry's year-over-year loan growth rate of 1.7%, that's the slowest rate of annual growth since the third quarter of 2021, has steadily declined over the past year. That annual increase was led by credit card loans and CRE loans. Loan growth at community banks was more robust, increasing 0.9% from the prior quarter and 7.1% from the prior year, led by CRE and residential mortgage loans. Asset quality metrics were generally favorable, with the exception of material deterioration in CRE and credit card portfolios. The industry's overall non-current rate increased 5 basis points from the prior quarter to 0.91%. That's a level still well below the pre-pandemic average non-current rate of 1.28%. The increase in non-current loan balances continued among non-owner-occupied CRE loans, driven by office loans at the largest banks, those with assets greater than $250 billion. In addition, the next tier of banks, those with total assets between $10 and $250 billion, is also showing some stress in non-owner occupied CRE loans. Weak demand for office space is softening property values, and higher interest rates are affecting the credit quality and refinancing ability of office and other types of CRE loans, and as a result, the non-current rate for non-owner occupied CRE loans is now at its highest level since the fourth quarter of 2013. In addition, driven by write-downs on credit cards, the industry's quarterly net charge-off rate remained at 0.65% for the second straight quarter. That is 24 basis points higher than the prior year's rate. The current net charge-off rate is 17 basis points higher than the pre-pandemic average, and the credit card net charge-off rate of 4.7% was up 55 basis points quarter over quarter and was the highest rate since the fourth quarter of 2011. Domestic deposits increased for a second consecutive quarter, this quarter by $191 billion, driven by growth in transaction accounts. The shift away from non-interest-bearing deposits toward interest-bearing deposits continued, as interest-bearing deposits increased 1.7% quarter over quarter, and non-interest-bearing deposits declined for the 8th consecutive quarter. Estimated uninsured deposits increased $63 billion in the quarter. That represents the first reported increase in uninsured deposits since the fourth quarter of 2021. The number of banks on the problem bank list, those are banks with CAMEL's composite ratings of 4 or 5, that's on our supervisory scale. The problem banks increased from 52 in the fourth quarter of 2023 to 63 in the first quarter of this year. That number of problem banks represented 1.4% of total institutions, which was within the normal range for non-crisis periods of 1 to 2% for all banks. Total assets held by problem banks increased $15.8 billion to $82.1 billion during the quarter. The deposit insurance fund balance was $125.3 billion on March 31st. That's up $3.5 billion from the end of the fourth quarter. Insured deposits increased by 1.1%, about half of typical growth in the first quarter. The reserve ratio of the deposit insurance fund, that's the fund balance relative to all insured deposits, increased by 2 basis points to 1.17%. That reserve ratio currently remains on track to reach the 1.35% minimum reserve ratio by the statutory deadline of September 30th of 2028. So, in conclusion, the banking industry continued to show resilience in the first quarter. However, the industry still faces significant downside risks from the continued effects of inflation, volatility in market interest rates, and geopolitical uncertainty. These issues could cause credit quality, earnings, and liquidity challenges for the industry. And in addition, deterioration in certain loan portfolios, particularly office properties and credit card loans, continues to warrant monitoring. These issues, together with funding and margin pressures, will remain matters of ongoing supervisory attention by the FDIC. That concludes my prepared statement, and I'd be glad to take your questions. Thank you very much.
Thank you, Mr. Chair. We'll now take your questions on this month's quarterly data. Our first question is from Andrew Ackerman from the Wall Street Journal. Go ahead, Andrew.
There's an echo here. Sorry about the audio issue. I guess I had a question about the transformation monitor, and I guess I was just trying to understand if the chairman would consider, is prepared to relinquish any of the action plan items until the third party oversees is put in place. Thanks.
Not sure I understood the question. As I've indicated previously, we've actually issued a request for proposal for a independent monitor, and as recommended by the report, the approval of the independent monitor will be undertaken by our board of directors. Thank you for the question.
Sorry, he addressed it on the recording. I mean, it sounds like, from what I'm hearing, the the staff are taking direction from the chairman, but he's saying the actual decisions are ultimately being made by the board. Is that correct?
We circulated the request for proposals to all the members of the board. All the members of the board had an opportunity to comment and make suggestions on the request for proposal, and the approval of the independent monitor, as I indicated, will be done by the board of directors. Thanks.
Our next question is from Michael Stratford at Politico.
Hi, thanks for doing the call. Chair Greenberg, can you explain for us why you decided to step down pending the confirmation of a successor rather than right away? And is there any scenario in which you expect you would resign before a successor is confirmed?
Continues to serve until a successor is confirmed by the Senate. That's my intention. I think the agency benefits from having a full board, and that was my commitment to follow through on that. Thanks.
Katanga Johnson from Bloomberg.
Thanks so much for taking time today. Two questions. One, just curious about whether unrealized losses are still regarded as an imminent problem to banks, especially as smaller regionals and community banks. And then whether any notices have been sent for corrective action. Of course, you can't name firms, but perhaps you can address whether any notices have been issued.
The question, Katanga, I think the answer is yes. We still have a historically high level of unrealized losses across the banking industry, unrealized losses on securities, as I indicated in the statement, and also on loans that have been accumulated on the balance sheet of banks. So I think that's a focus of supervisory attention. And as we noted, it really fluctuates from quarter to quarter, but with the rise in mortgage rates, unrealized losses for the industry as a whole went up. And there are concentrations, across institutions in the industry, which are definitely a focus of supervisory attention.
Thank you. And then I was just curious more broadly about the agency's agenda. I know one item that hasn't yet been proposed is a measure on liquidity. Are you able to speak about your thinking around not just the timing, but what that measure might look like? I know we've heard from other agencies, Vice Chair Barr, the Fed has spoken about it. Acting comptrollers too have spoken about it.
That's definitely an area of attention for all three banking agencies. I think liquidity management was one of the real challenges and vulnerabilities identified in the bank failures of last year. And as I think we've all indicated publicly in one way or another, particularly a management of collateral in an effective way so that banks can access the Federal Reserve's discount window, particularly during times of stress, is, I think, really a focus of attention. And consideration is being given to developing a rulemaking requiring banks to pre-position quality collateral at the Federal Reserve banks, both to access liquidity during times of stress and also to demonstrate their operational capability to access the discount window, and also to push back a bit on any market stigma from utilizing the discount window. So that's an area of definite attention, I think, for all three of the banking agencies.
Would you say that you're closer to or further away from proposals, say between now and the end of the year?
Projections, but I think this is a priority for us.
Thank you. Pete Schroeder from Reuters. Go ahead, Pete.
Hi guys, thanks. I just wanted to ask more broadly, Chairman Grunberg, is it your intention to continue working on the existing regulatory agenda? Is it a priority for you to try to get some of these proposals across the finish line while you're still the chairman? Just what's your general thinking about how you...
Okay, in the statement I put out, I said we would continue to carry out all the responsibilities of the FDIC, and that would be my intention.
All right. Wanda, your hand's back up. Go ahead.
Just one more, if I may. Just was curious about the capital plan and whether, as of today, the 29th of May, is it your understanding that the plan is still moving ahead?
I think the answer to that is yes. The agencies are working together, focused on reaching agreement on substantive changes to the notice of proposed rulemaking, based on the extensive and constructive comments that we've received. So I think it's very much a focus of attention and priority for us.
Great. Michael Strickford at Politico, I see your hand still up. Did you have a question?
Yeah, thank you. Chair Grunberg, have you had any conversations with the White House about who a nominee might be? And do you have thoughts on
Short answer is no.
Did we have any questions? Seeing none, we will conclude our live stream there. Media are welcome to remain on the line and speak with senior staff.
And thank you, everybody. Take care.
Again, we have Pat Mitchell and Rainy Miller.